Be Wealthy and Smart, episode 532.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about a couple of different articles that I found that I really wanted to talk with you about and share with you. So I'm calling this episode, Is Investing Money in Sector ETFs a Smart Financial Move? And as I said, we are going to look at two different articles, one about sector ETFs and three that have done extremely well already this year, and another article about the market sentiment. And that is more in regards to the timing of whether it's a good time to jump into the market. Not that I try and time the market, but I am very conscious about market moves. And we had this massive market move from the December 24th lows, and the market has really shot up strongly since then. And it's making a quadruple top. If you look at a graph of the market, it looks like it's reached this point for the fourth time and has yet to break through on 4 attempts. So we're going to talk about what that means, what sentiment is telling us in terms of what the market might be doing. And I just haven't really covered that for a while, so I thought I would chat with you about that and just, some yellow caution flags out there that I'm seeing, or maybe even red flags. Yellow, red. Anyway, they're blinking caution. So we'll talk about that. But before I do, I also want to let you know that I will be announcing the winners of our contest for February. So at the end of this podcast, I'll be mentioning 5 people who won the Wealthy Mindset Blueprint audio sets, valued at $197. The 5 people that have won my You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now book, and I will personalize those for you. And then 5 people who won a wealth mentoring session with me, valued at $500. So remember that sometimes your name isn't your name when you leave the review. Sometimes you're leaving a code or abbreviations or something like that. So you're going to have to figure out if it's you that I'm mentioning when it's not your name that I'm reading out as a winner, okay? So anyway, I'll get to that at the end. But another thing I wanted to mention to you, I just wanted to share something that is really exciting and personally really meaningful to me. At the beginning of every podcast, I say the same thing, and I talk about being America's Wealth Mentor, but about making a global difference. And that's truly what is in my heart, is to make that global difference. So there is a report that I get by email, and it tells me where my podcast is popular. And I wanted to share this because it meant so much to me to just hear how the Be Wealthy and Smart podcast is spreading globally. And I want to thank people who have been sharing this with friends, with family, and have been getting the word out and just sharing the podcast with other people. I am so grateful to you for doing that, because Be Wealthy and Smart is hitting the charts not only in the United States, but also in India as a top business and investing podcast, also in the United Kingdom, in France, Korea, and the Netherlands. So for those of you who are in those countries, thank you so much for listening and for making Be Wealthy and Smart popular there. Thank you for sharing it in your country. And I just am thrilled that we're getting listenership all over the world, that you can see the principles of wealth building are very classic, that you can put these into practice. They're timeless. And I really try to make it very educational so that you can apply not only what is current information, but also what is everlasting information in terms of investment tips. So thank you everybody who's been sharing this on a global basis, and welcome to all of our international listeners. All right, so what I wanted to talk about first was an article that I saw about sector ETFs. Although instead of sector ETFs, they're calling them thematic ETFs. So an ETF, as you know, is an exchange-traded fund, and they're groups of similar companies that are put together, and you can invest once and buy the whole portfolio. And that's what makes them very easy to invest in. It also makes them very low cost because they're a static portfolio. So you're not paying a money manager to make buy and sell decisions. They pretty much are just staying the same. Well, this article, which was written by Sarah Ponczek and appeared on Bloomberg, is called Investing on Steroids Pays Off as Thematic ETFs Trounce Market. And then she's got a couple of bullet points here. One is marijuana, solar power, clean energy funds up more than 30%. And her other bullet point says niche funds come with high reward but also elevated risk. And the article says, for returns more than triple the stock market average so far this year, look no further than a quirky group of exchange-traded funds that bet on the latest investment fads. The top 3 performing U.S.-listed non-leveraged ETFs this year are so-called thematic funds, or niche products that focus on categories. From marijuana to solar power to clean energy, portfolios constructed with companies betting on industrial and social transformations are trouncing rivals across the broader equity market. Well, I want to pause there and say, I don't consider these investment fads at all. I consider these new technology, coming off prohibition, great growth markets. I consider these anything but an investment fad. But it's interesting that she wants to call them an investment fad. The other thing is she mentions specifically non-leveraged ETFs. And that means there is no debt or multiplication to these ETFs, if you will. We've talked in the past about how you can buy an ETF that can go up 2 times the market or 3 times the market, or it goes up when the market goes down. It goes up twice as much as the market goes down. It goes up 3 times as much as the market goes down. Inverse ETFs, those are called. We've talked about those. I'm not a big fan of leveraged ETFs, but some of those can have very big moves because they are leveraged, because they are moving in multiple to the market. So they're moving 2 times as much or 3 times as much up or down. And so sometimes you can get very skewed performance with those leveraged ETFs. It can sometimes be enormous. For example, just, coming off the market low from Christmas Eve, December 24th last year, till now, the market's pretty much just gone straight up. And so I'm sure those leveraged ETFs went crazy on the upside. But now they're possibly ready to turn to the downside and can lose money twice as fast. So I am not a big fan of leveraged ETFs, but I wanted to point out that there are probably leveraged ETFs that have better performance than these 3 that she's reporting on. All right, the article goes on to say, while it's only the end of February, their performance has been astounding. The ETF MG Alternative Harvest ETF, ticker MJ, which wagers on the growth of cannabis, has surged nearly 50%. 50, that is. A fund that focuses on solar power, the Invesco Solar ETF, symbol TAN, and the Invesco Wilder Hill Clean Energy ETF, symbol PBW, which holds companies across the new energy spectrum, have both gained more than 30%. This is really investing on steroids, says Todd Rosenbluth, Director of ETF Research at CFRA Research. You're taking significant risk. Sometimes that gets rewarded, but you're going to fail quite often with these investment strategies. All right, I want to pause there for a moment. Well, he is right in the sense that for investments to go up 30 to 50% in 2 months is highly unusual. And if you're not an investor that owns those investments, and you're considering going in at this time, it could be highly risky because investing in something that's already gone up 50% means it can easily drop by half that much. And you don't want to be buying at the top only to have half of your money lost. So that's why I'm always cautioning you and telling you to dollar cost average into investments if it's something that's right for you and you've done your research and aren't just relying on what I'm reporting here, because I'm just giving you the news. I'm just reporting what is. But I'm also telling you some of my opinions and some of my favorite investments. But it is important to try to buy when these kinds of large gains have pulled back rather than ignoring that and just jumping in. Because a lot of people just ignore it and they jump in. They have that fear of missing out, that FOMO, and they jump in and it's right at the top when investor sentiment gets all frothy and everyone's all excited and it feels like it's going to last forever. And then the market turns sharply, heads down, and like I said, it's easy to lose half of that amount just from a regular pullback. Now that happens because people are going to take profits. They want to lock in those gains because after all, a 30 to 50% move is not only one good year in the stock market, it's 3 to 5 good years in the stock market if you consider the stock market averages about 10% per year. So those kinds of gains at 30 to 50% are very outsized. And they're also a more aggressive way that you're investing because you're putting all your eggs in this particular type of technology or this particular type of growth investment like cannabis. So there is additional risk. I do agree with him, and I do think that there are ways to minimize that, such as dollar cost averaging, buying small amounts over time and not just jumping in all at once, and also paying attention to, are we close to a pullback? And that's what we're going to talk about in our second article. So then in this article, it shows a chart of the ETFs. It charts them all against the S&P 500, and you can see how it's handily outperforming the S&P, which is up roughly 12% year to date. And these are up over 30%, and in the case of MJ, up almost 50%. The article goes on to say, most recently, investors have been compensated for the risk. While the S&P 500 is experiencing its best start to a year since 1987, these funds have tripled year-to-date returns. But that comes after a volatile 2018. All three funds fell more than double the benchmark index. In fact, TAN saw losses 4 times greater than the S&P 500's 6.2% decline. But while performance has wowed, investor flows haven't necessarily followed suit. So far this year, investors have pulled cash from TAN and PBW. The weed-focused fund, meanwhile, has taken in $227 million, sending its total assets above $1 billion. In the more than $3.5 trillion ETF industry, thematic ETFs have grown increasingly popular as issuers look for ways to differentiate themselves while charging more money. Last year marked a record for thematic ETF launches. State Street Corp set out with the first ever fund tracking space and deep-sea exploration. Other niche products look to pets, self-driving cars, and the growth of artificial intelligence. Thematic ETFs on average cost investors $5.80 for every $1,000 invested, compared with $5 for all ETFs. So they're making the point that these thematic ETFs are about 80 cents more expensive than a regular average ETF. With higher costs and elevated risk, ETFs such as these aren't for everyone. At Kingsview Asset Management, the team tends to stay away from thematic ETFs since they're more the flavor of the day, according to Paul Nolte, a Chicago-based portfolio manager at the firm. If you hit them right, they're wonderful. They're up huge amounts already this year, Nolte said. But if you hit them wrong or you think this theme is going to work out and it doesn't, you'll end up with a big dud. End of article. All right, so not too encouraging from people there, but I think it's important not to just invest because it's a fast horse. We're not buying a fund simply because it's gone up. And there needs to be some sort of thesis behind the fund. If you've listened to my podcast about cannabis and why investing in cannabis is one of my favorite investments this year, then you'll understand that we're looking at growth to a $500 billion, $500 billion market. It's like coming off of prohibition. It's like investing in pharmaceutical companies before they grew large. It's like investing in some veterinarian companies and products, pet products. It's a combination of all of those things because of the different uses for cannabis, for CBD oil, etc. So the market is extremely large. Now, I'm not invested in the other ETFs mentioned in this article, TAN and PBW, but it's kind of interesting to look at solar, and that might be something to look at and something to consider. But again, I don't look at it just because they've gone up a lot. I look at it because I have a thesis about why a market is going to be a huge growth market. And so that's why, really, out of this article, the only one that is on my radar right now is MJ. I think they make a good point talking about the caution and the volatility. You do have all of those things. And on top of that, you have spectacular performance in just 2 months. So again, I want to just caution you not to be jumping into things without really thinking about this, looking at where the market is, looking at if it's a bit too frothy and if we're about to have a serious pullback, and maybe nibbling a little bit in at that time, tiptoeing in a little bit, or buying a little bit at regular intervals rather than trying to buy it all at once. Of course, I will post this article in the show notes, along with this second article I'm going to be sharing with you too. So both of these articles will be in my show notes this time and on my website. The second article comes to us from ZeroHedge.com, which is one of my favorite investment websites. If you haven't followed ZeroHedge.com, it's ZeroHedge.com. And sometimes they use lingo and jargon. It is for very advanced investors. A lot of hedge fund managers do read this. Sometimes they do get a lot of acronyms and lingo that if you're not an experienced investor, it can kind of trip you up a little bit. And this one really didn't have too much lingo in it anyway. But at times they can get very into acronyms and lingo. And so just be aware of that. It's not you. It is the website. That's just the way they talk. And it is, again, geared mainly toward hedge fund managers, I would say. So this article was written by hedgefundtips.com, posted on the Zero Hedge website. It's called Warning Signs from AAII Sentiment Survey Results This Morning, and it was dated February 28th, 2019. It has a nice chart here that shows that current sentiment is very bullish at 41.63% and only 20% for the bears. And it points out other times in history where people have been very bullish, meaning those people are very optimistic that the market is going to go up. A person who's bearish is pessimistic and thinks that the market is about to go down. Here's what the article says. AAII Sentiment Survey results are out this morning. Oh, by the way, AAII is the American Association of Individual Investors, and they do a sentiment survey, meaning they poll all of their members to see whether they're bullish or bearish. And oftentimes, when they are most bearish, especially if they are over 40%, can indicate an important top in the market. All right, so I will start over. AAII Sentiment Survey results are out this morning. Bullishness is now up over the 40 level, which usually marks market reversals. Bearishness has collapsed. In the S&P 500 chart below, I have noted those dates in the recent past where sentiment was at similar levels, where bullishness was about 40 and bearishness was less than 30. You can follow along with the red circles on the sentiment results above, and it's referring to that chart I mentioned. Just because these readings correlated with pullbacks in the recent past does not mean they will do so this time. It does, however, mean we should be paying attention. It is possible we can burn through these elevated readings and go higher, but the odds don't favor it. As with all indicators, they are to be used as barometers, not crystal balls. So meaning that we can sort of estimate, but it's not really providing an immediate or necessarily 100% accurate indicator about the market. So that was the short article. It really is about the chart that they posted with past results of the survey and past peaks in the survey that are very similar to today. And then it also has a chart of the S&P 500 where it shows that these major peaks in the market happened when sentiment was over 40%. And once again, we've reached that 40% area. As I mentioned earlier, we've also reached the fourth time the stock market has reached this particular level. So we have what a chartist would call a quadruple top, meaning we have 4 peaks. If you think of like a mountain peak, we have 4 mountain peaks that have hit the exact same height. And so that can tell us that there's some difficulty of the market breaking through that level. It can be a sign of a bigger top, that maybe we're going to have a more serious decline or pullback. So those are things to consider. We can't tell for sure. They're just indicators that we look at. Just like I always talk about the instrument panel on a plane and how they give indicators when you can't see visually where you're flying. You have to look at your dials and your indicators. And this is one of those dials or indicators that we look at to see what we think the market's going to do. So what this article is saying is that we could be near a major top and ready for a big pullback since we've really come off those, again, the Christmas lows with a straight up shot in the market, and we really haven't had a serious pullback. It's time for people to lock in their profits. It's time to get some of the frothiness out of the market. It's time for a pullback, especially if we are at a quadruple top. It's signaling again, maybe this is time for a more significant decline. So time for caution for sure. Doesn't mean the market can't turn around and break through that quadruple top tomorrow. It could, but these are signs that are telling us that caution is warranted. So the last thing I would want you to do is jump into an aggressive, concentrated thematic ETF right at this time. So I really wanted to combine this sentiment article with the thematic ETF article just to show you with facts that caution is warranted. And I don't recommend jumping in at this time. Again, wait for a pullback, dollar cost average in, talk with your financial advisor who is pretty much going to say what that article said, which is that's risky, it's concentrated, they've gone up a lot. They're going to really caution you as well. So I want you to really take some time. There's no rush to making investments. You should always be monitoring things before you make a decision and be doing thorough research before you decide if this is the right kind of investment for you. And always start with a small initial investment. Don't ever jump into anything large. Don't ever make a purchase based on a podcast that you've heard or a tip you've been given. Do your research, study up on it, study up on the opportunities, and really have a good sense why you want to make an investment. Because otherwise, if the market does have a more serious pullback and you're not really well rooted in why you made that investment decision in the first place, then you're just going to panic and sell out of it possibly. And I wouldn't want you to do that because then that's locking in your losses. So again, caution is warranted. Do your research. Don't take this as investment advice. Take a look at the charts and the articles that I've mentioned here. Study up on this. Really try to understand what's happening and don't go on any tips or advice that someone else gives you. You really need to make some good decisions for yourself and have a good understanding why you're making them. All right, now we're going to have some fun talking about the reviews that people have left. First, I want to thank everybody who has left a review. It means so much to me that you have reviewed the podcast or the book or both. I really am so grateful to you. I really don't know how to thank you enough. The reviews have been coming in so amazing. I'm incredibly humbled. I'm incredibly amazed. And I just can't believe what an amazing group of listeners and readers that I have. I just think you guys are amazing, and I'm really, really flattered by what you've said. I'm so thrilled, number one, that you love the book. As a first-time author, I had written a wealth journal before, but this is really my first book, if you will. And certainly going through a traditional publisher, it was a long journey, a 3-year journey to find a publisher to publish me. And it was really a humbling experience to be turned down. And then to find someone who really wanted to publish my book. It was funny because only that publisher had really read the book. That and an editor I'd hired. No one else had read my book. And so when the book went out, I thought, oh my gosh, I really don't have feedback from people about my book other than from my publisher. And my publisher loved it. So it was really amazing to read the feedback from people who have read the book and who love it and who are seeing the difference between it and other financial books and seeing some of the interesting things about bubbles and cycles that I have written and just about side hustles and gaining confidence and some of the stories and mindset, all kinds of things that people are enjoying. But it's so thrilling to me to hear that you love it and to get the great feedback because, like I said, it was kind of, I wrote it, the publisher saw it, and that was about it. My editor and I, so I'm thrilled. And thank you from the bottom of my heart, everybody. So I have done the drawings, and we have 15 people that have won something today. So again, when I read your name might be in code or it might be different than your real name, that whatever name you used for your review is the only name I have for you. So I'm going to read what was left in terms of your name on the review, and hopefully you'll know it's you. And you can contact me at lpjhome@gmail.com if you're a winner, and just put winner in your subject line. All right, for the Wealthy Mindset Blueprint audios valued at $197 each, the first winner is Melanie. Congratulations. The second winner is Priya, Priya. I don't have a last name for either of you. The third winner is D like David, K-U, T like Tom, K-A, D Kutka. That's the third winner. The fourth winner is Meli Kari, Melicari. And the last winner is an amazing name. I can't say the word. I'm going to have to spell it out. It's GHCHGXGHBDHHGD. There's no vowels. So, I can't read the word. So it's GHCHGXGHBDHHGD. Hopefully you know what that means. So congratulations. You have won the Wealthy Mindset Blueprint audios. Please send me an email with winner in the subject line to lpjhome@gmail.com. For the Wealth Heiress books, this is a Wealth Heiress book, the book I wrote with a personalized message to you in the front of the book, and of course I'll sign it as well. So you can also contact me with winner in the subject line to lpjhome@gmail.com. The first winner is Karen Walzel, Walzel. Congratulations, you won a book. The second winner is BBFFJJSHT. BBFFJJSHT. Congratulations, you've won a book. The third winner is Iggy Cortez, IGGYCORTES. Iggy Cortez. The fourth winner of the book is CHEMOWA5, Chemawa 5, CHEMOWA 5. And the fifth winner is Addicted to Stories. Congratulations, you've all won a Wealth Heiress book. and I will be happy to personalize it for you. Just send me an email at lpjhome@gmail.com and tell me you're a winner, and we'll talk about what you want me to say to you, and I will be happy to sign it. Some people also have me address it to a friend as a gift or to their children so that they have a nice personalized copy. And other people already own a copy. They give that to a friend, and then they have me personalize it to you. So that's fine too. And here we go for wealth mentoring sessions with me, valued at $500. The first winner is Monica Butchek, Butschek. Sorry if I goofed that up, Monica. Monica Butchek, Butschek. The second winner is Tejobal, Tejoball, Tejoball. The third winner of the wealth mentoring session is Dave Burr, Burr, Dave Burr. The fourth winner of the wealth mentoring session is Roz Pack NW, Roz, R-O-Z, Pack, P-A-C-N-W, Roz Pack NW. And the final winner of the wealth mentoring session with me is Roslyn Albee, A-L-B-E-E. Roslyn Albee, A-L-B-E-E. So please send me an email with winner in the subject line to lpjhome@gmail.com. And congratulations to everyone who has won. As you know, we have another drawing in March, and everybody who's already entered and written a podcast review or a book review is also entered into the March drawing. But if you haven't left a review yet, time to get started. And please leave a review on Amazon for the book or on iTunes for the podcast. I would so appreciate that. All right. And don't forget, we still have our survey going on, 10 questions that just ask your input about the podcast so I can tailor make episodes for you. And if we haven't connected yet on Instagram, go on over to instagram.com/Linda P. Jones, or connect with me on Twitter at Linda P. Jones, or on my Facebook page at Linda P. Jones fan page. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.